What's up, everyone? Welcome to another video. This one's going to be a quick market update. The market has been showing some signs of bullishness, so we want to check out the technical levels, see what's been going on lately. Here is S&P 500 futures on the daily candles. You can see the price is just near the previous highs that we created at the beginning of October that I've highlighted here. This is also a long-term Fibonacci level. It's a very strong Fibonacci level. It's right around the 380 level, or 3800 I should say. And I'll show you on the long-term picture with the weekly candles. This is a retracement level from this current rally since the pandemic crash. The 61.8 Fibonacci level, 61.8% Fibonacci level. I mean, that's a strong support or resistance level. You can see how the price bounced really strong off this 50% Fibonacci level previously. So that shows you that these Fibonacci levels are valid, so you got to follow those. But right now, SPY's price needs to get above those previous highs and above this Fibonacci level. You might see a lot of investors piling in if we get above this 3,800 point. You might get a little momentum in price, might find a good day trade if you're an options trader. And even a rejection of this level, man, you can get some really good trades off that. And this might very well happen tomorrow. We got a really important day for earnings Tuesday. You got Microsoft, Google, Visa, a lot of the big heavyweights in the S&P 500. It's probably the biggest earnings day for this earnings season. This whole week is very important as well. So this whole week will decide if we're going to get a little bear market rally or not. So we'll find out Tuesday, tomorrow. Other than that, on the short term, the market looks somewhat bullish. It looks like we're rising above a short-term downward trending resistance. That's somewhat bullish. RSI looks like it's opening up, crossing above the 50 value. That's the bullish territory. MACD opened up previously. It looks like it's climbing back up to the histogram. We'll see if it climbs above that or rejects the histogram. If we do get a rally, I'm watching this dynamic resistance level, just connecting these two previous highs right here and right over here, and that gives us a weak dynamic resistance level, but sometimes the price will react to it, so keep an eye on that one. Other than that, we have somewhat of a resisted zone at the 3900 to 3950 area. All this yellow I've marked here, watch out for that resistance. That's a shorter term resistance, but it should be choppy on the way up here unless we get amazing earnings from these big names, because there are a lot of bearish resistance levels we're going to have to deal with here. But this 3900 is the first zone to watch for any kind of rejection or friction in price action. But to keep it simple, the long-term trend is down here. The Fed's interest rate hikes were killing the markets lately. This bullishness might have been coming from some of the comments from the mixed signals in the Federal Reserve. Some of the officials are calling for slowing rate hikes. Some call for a smaller rate hike. So we're getting a little bullishness off of that. And generally speaking, we've had some pretty good earnings, but the long-term trend is down, so we want to be looking for shorts. Going long in the short term can be profitable, definitely. I got a long position. But in a bear market, any bad news will give punishment to equity, so keep your ears open and don't just blindly hold calls. And I have a long position because the market's showing short-term bullishness at the moment. Let's check the macro indicators, the ticker symbols that follow the macro environment. See if this bullishness will last. Here is the dollar index. It looks like the dollar index is rolling over, starting to trend down, and that's bullish for equities. If you didn't know, when the dollar's going down, generally speaking, the market will be going up. If the dollar does continue to fall, these are the dynamic upward trending support levels that I'm watching right here. These are where I expect a bounce in price action, possibly if this trend's going to continue, because the dollar has been rallying within this price channel for, all year, basically since last November almost. And I also want to point out, when we zoom out on the dollar, looking at the monthly candles here, this is the very long-term picture. We have a previous highs here. This can be a resistance zone if you're a technical trader, and right now the price is right up in that zone, so we might catch some resistance. If the Fed really does slow rate hikes, that'll be really convenient. It's happening conveniently at this very long-term resistance zone. So we could get some choppiness here. We might even reject it if the Fed talks about slowing rate hikes, or actually does. But if inflation skyrockets and the Fed has nothing to do but raise interest rates, then the Dollar's going to break out again. I'm confident of that. But if you trade technical levels often or every day, then you'll notice that big news stories like Fed slowing interest rate hikes or talks about it, that happens around major support and resistance zones or major technical levels. So keep eyes out for this zone here. It's around the 114 to 120 level around there. But most importantly, if the dollar breaks down out of this wedge, that'll be bullish for equities. If it starts climbing again, that'll be bearish for equities. Always remember that, especially in this high inflationary environment, high interest rate environment. And I guess that brings me to yields. Here's the 10-year yield. This thing's been on a massive rally with the dollar. The Fed's increasing interest rates. Inflation is expected to be high in the future. That makes investors cautious. That brings the yields up. The 10-year yield specifically is what we need to see come down for equities to be bullish, at least in the current environment. In the past, you want to see a slow uptick in yields. That's kind of bullish for equities. It is indicative of economic growth, basically. But with this high inflation environment, we want to see yields come down to be bullish on markets right now. So watch for yields to fall, 10-year yield and the 2-year yield more specifically, and that should be bullish for equities. But right now, it looks like it's still just kind of wants to break out. It's kind of looking like it's rolling over, but not quite yet. So technically, it's not very bullish for equities right now. Same goes for the dollar here. We want to see a full breakdown out of this wedge to get bullish on equities. Right now, it's kind of trying to break down, but it hasn't completely, so you can't be super bullish in the equity picture, even though it's looking really green the past few days. Now, I should have went straight to VIX after SPY. This is the VIX index. It tracks the intraday movements of the VIX during U.S. intraday trading hours. And you can see we're breaking down out of this price channel. That looks bullish for equities. And I should also mention that VIX is price where it seems to be rolling over is near these previous levels. It was a really good time to go long on the market on the very short-term picture. That's another reason why I got a long position, because we're near that level, and it was a really profitable time for any long positions. Who knows if this downtrend will stick? It might all depend on earnings, like I mentioned. And I should mention quickly for those that don't know, when VIX is going down, then generally the market will be going up like SPY, or if VIX is going up, then the market will be going down. I like to follow corporate credit as a possible indicator of future price movements in equities. This ticker is LQD, and this is liquid companies, hence LQD. But basically, if investors are piling into this, then they have a good outlook on the future credit of companies. Just like companies in the SPY, these are the bigger, more liquid companies that are more likely to survive economic recession or a bad economic environment. And right now, this thing is in a strong downtrend. It's not even trying to test any resistance. It's not trying to break out. This thing's headed down. That's bearish, in my opinion, on equities. Some people believe that equity markets follow the bond markets, so always keep eyes on these tickers. Here's the ticker HYG. This ticker symbol follows the corporate credit markets for the less liquid companies, like smaller companies that are more likely not to survive an economic recession. We got some consolidation going here. This is actually performing better than LQD, which is surprising, but it still hasn't quite broken out. You could call it somewhat of a wedge pattern, not really. We need to see some upward momentum in this to be bullish on equities. Price did recently break out of this downtrend, this little channel that I've highlighted here, and that's kind of bullish, but right now it's consolidating. Maybe, possibly, if we get some upward momentum, then you'll see equities going up as well. Now that's all the ticker symbols I look at every day, basically, to get a macro picture, see how the market's feeling, see even if I should go completely bullish or not. And it's kind of a mixed bag, so I'm not super bullish, but on the short term, we have some bullishness. I mean, I've highlighted the bullish price channel that SPY's been traveling upward within. It would look a lot more bullish if we get above the previous highs made around October 7th or something like that. Short-term picture does look bullish. Dow Jones is in full rally mode. It already passed the highs that it made on October 7th if you look at its chart. Nasdaq's climbing. I mean, if we get good earnings this week, the market might go bullish until the next Fed rate hike. Who knows? Just always remember, though, that in a bear market, we should be looking for short opportunities. Right now, the short-term picture is looking bullish. Got a short-term long position. But if these earnings turn out to be pretty